Okay, most UK directors don't realise this until it's too late. The way that you handle your company's closure could determine your financial future for years to come. So if you ignore the warning signs, you can risk personal liability, director disqualification, a whole raft of headaches. But listen, don't worry. The next 30 minutes, I'm going to walk you step by step through everything you need to know about liquidation, administration, selling company assets, and avoiding personal risks as a director. So it's going to leave you with some clarity, confidence, and a clear plan to move forward. Please, Chris Worden, Director First, make sure you subscribe to this channel and hit the notification bell. At Director First, we simplify complex insolvency topics so you can protect yourself, your reputation, and your future. Let's dive in, okay? I've worked with thousands of UK directors who are facing financial challenges. I have seen the sleepless nights, the fear of the unknown, and the relief when they finally take some action. Today, we're going to make insolvency a bit easier to understand so you can take control of this situation. Now, here's what we're going to cover. How liquidation works, you know, why acting early is critical, when administration is a better option to save your business. I'm going to tell you about the right way to sell assets without risking a headache down the line. I'm going to talk about compulsory liquidation and winding up petitions. And I'm also going to tell you what you need to know about your responsibilities as a director. And I'm going to finish up with the tax saving benefits of something called a Members Voluntary Liquidation. And by the end of the video, you're going to have all the tools that you need to make the best decisions for your company. So we'll start with liquidation, okay? It's a formal process of closing a company and selling its assets to repay creditors if there are some assets. Now, if your company is insolvent, all it means is it can't pay its debts as they fall due, or its liabilities are more than the assets. Liquidation is often the most appropriate and legally compliant option. Now, the most common types of liquidation for an insolvent company is something called a Creditor's Voluntary Liquidation. And it's initiated by the director and it's approved by shareholders. And it gives you a structured way to wind down a limited company and protecting you from legal risks. Now, a lot of people don't know what insolvency is, or if they don't know whether their company is insolvent. So there are two key insolvency tests that determine whether your company is insolvent. The first is a cash flow test. Can your company pay its debts as they fall due? If you're missing payments to creditors, suppliers, or you're on a time to pay with HMRC, your company's likely insolvent. The second test is the balance sheet test. And it's essentially, does your company's liabilities exceed its assets? So that's like your fixed assets, stock, cash, money due in, versus the outstanding debts. And if you fail either of these tests, it's crucial you've got to act quickly. That's a warning sign. Because if you continue to trade while insolvent, you can get accused of wrongful trading. That's something you definitely want to avoid. So what is a CVL and how does it work? A CVL is what you call like a vanilla liquidation, a bog standard liquidation. And it's the most common type of insolvency process right now. It basically allows a director to take a proactive control of the situation, protect the reputation, and reduce the risk of liability. And here's how it works step by step. You engage an insolvency professional or an insolvency practitioner, and what our role is to assess the company's financial position, and basically that just confirms whether you're insolvent or not. And then what we'll do is we'll advise on the best course of action to take. And it could be a liquidation, it could be an administration, it could be another insolvency solution, or guess what, it might not be any type of insolvency option. You just need an arm around you, a bit of good advice, and you go back in there. Now, If it is a liquidation, an insolvency practitioner oversees that process from start to finish. And if there's some assets that can be sold, some monies can be paid back to creditors. And the reason why it's so critical to seek out professional advice is it can protect you from accusations of like wrongful trading, and it can essentially give you some professional advice on what the best option is, because as a director, you can sometimes get blinded by this stuff. You know, you're just in survival mode, you're tunnel vision, and you're not taking an objective view of the company. Now, the second step is, if you are going to go into liquidation, is you've got to get a shareholder resolution. Now, at least 75% of shareholders must approve the resolution to enter liquidation. And the insolvency practitioner is there to handle all the preparation of the necessary docs, you know, the resolution to wind up the company, the appointment of the liquidator, notice for creditors, notices for shareholders. There's loads of paperwork, guys. Loads. You can't even imagine how many bits of paper you're going to have to sign. Step 3 is you notify the creditors and you hold the creditors meeting, right? So once the shareholders have approved the liquidation, the IP notifies all the creditors and invites them to a creditors meeting 21 days in the future. And at the meeting, a creditor can confirm or object to the appointment of the liquidator, okay? They can also ask questions or raise any concerns about directors' actions leading up to insolvency. Now, we probably work on about 50 jobs a month, right? 50 liquidations a month. I would say in 49 of those liquidations, no one turns up to the creditors' meeting. The HMRC don't, the banks don't, and if no one of your creditors turns up, you don't have to turn up. And 99% of the creditors' meeting now are done on the phone, okay? So at the creditors' meeting, the company enters into liquidation. The appointed liquidator takes control of the company, and here's what happens next. Obviously, the company immediately stops trading and the employees are made redundant. If there's any assets in the business, a liquidator will value the assets and sell them to try and repay something back to creditors. At the end of it, there is creditor distributions, okay? The liquidator distributes the proceeds from the asset sale to creditors in order of priority. Listen, in lots of insolvencies of smaller companies, no distributions go back to creditors. There is also an investigation of the director's conduct. So a liquidator investigates and submits a report on the conduct of the director to the insolvency service, okay? Now, the key risks for you as a director in a liquidation, you've got to be aware of these, is while it helps you manage the closure process, a director's still facing risks on this. Now, the big one I want to talk about is overdrawn directors' loan accounts. If you've taken too much money out of the company and not repaid it, it's treated as an asset during liquidation, and an insolvency practitioner will ask for you to pay it back. And if you're unable to pay it back, which is very common, this can lead to action from the liquidator. So the key thing is, with overdrawn loan accounts, you need to understand if you've got one. So where would you find that? You'd find it in financial information pertaining to the business. So in your last set of accounts, it'll say whether you have a director's loan account or not. The problem with your last set of accounts is they're quite far in the past. You really need an up-to-date financial statement to find out, and it'll be on a balance sheet of your business. Now, these things cause more problems to directors than anything else, and the problem is you don't think it's that important, and you think your insolvency practitioner will sort it out down the line. They're not going to sort it out. They're just going to ask you to pay it back. You've got to do this work before you appoint the liquidator. If you listen, I'm calling you out. If you're worried about a director's loan, call me today, 0800 086 2766, or you can book a free, no obligation, no strings consultation in the comment section below, right? Do not make the mistake of not dealing with director's loans. Another problem is preference payments, and they are payments made to creditors shortly before liquidation, often family members, paying directors back, key suppliers, or paying off personally guaranteed stuff. Now, if a liquidator determines that they are unfairly paid, this could cause you issues, right? Again, you've got to discuss these with your insolvency professional, because there are certain payments that could be in the interests of the company. So let's say you've got a key supplier, you've got a job to finish to bring some money into the company to repay creditors. It's arguable that paying that supplier towards the end is going to be helpful. So, wrongful trading is another problem, and it occurs when a director continues to trade even though they know the company's insolvent. And this could lead to personal liability, it could lead to disqualification. Crikey, you know, some of the worst cases can lead to imprisonment. So again, you're worried about any of these things, you become insolvent, you've got to take advice early, right? There are a lot of benefits to going into liquidation. You know, you've got control. A voluntary liquidation, you choose the liquidator. You know, you go out there, you find someone you can trust, find someone you can talk to, check their reviews, see if they do some great videos on YouTube. And this liquidation, it shows that you're taking responsibility, and that can help preserve your reputation. And if you act promptly, chances are you can avoid any accusations of misconduct or, you know, wrongful trading. And, you know, it's not always the end of the road, a CVL. You know, you could still start another company, even in the same industry, and start again. But again, you've got to take advice. Now, in this section, I'm going to talk about administration. Now, liquidation is often the best option for an insolvent company. It isn't always the only route. Now, sometimes a company has potential to be rescued or restructured, and this is where an administration may come in. And an admin is a formal insolvency procedure that's designed to protect your business from creditors, while an insolvency practitioner gets in and works on a plan to either save the company or maximise the return for the creditors. Now, in an administration, you've got to use a licensed insolvency practitioner. They're called the administrator in this scenario. They take over full control of the company, and the primary objectives are to rescue it as a going concern if possible. But if that isn't possible, they're there to sell the assets in an orderly manner, and this is the key thing, to deliver a better return to creditors than a liquidation would provide. Now, you might be asking, when would an administration be the right option? Well, it can be the right choice if your business has some value worth preserving. You know, you might have strong operations, intellectual property that could be sold off or restructured. You might need breathing room from creditors. Now, an admin provides a legal moratorium, and it means creditors can't take enforcement actions like a winding up petition, seizing assets, while you're in admin. It gives the business a chance of being saved, and if you believe the business can be turned around with new investment, cost cutting or certain restructuring, an admin could give you the time to make it happen. Now, the key benefits, in my opinion, of an administration is obviously the legal protection it gives you straight away, that moratorium. Because once you enter into administration, your creditors are legally barred from taking action against the company without the administrator's consent. So it halts court proceedings, stops bailiffs. You know, another benefit is it gives you the potential for rescue. An admin allows time to explore whether the company can be saved. Can we get some new funding? Do we need to restructure the operations, or do we need to sell parts of the business off as a going concern? And obviously the key driver here is, in an administration, it has to provide a better return for the creditors. So by managing the sale of the assets in an orderly manner, the administrator can often deliver high returns to creditors compared to liquidation. Now, I want to go through the steps of an admin and how it works. So the first one is you appoint an administrator. So the company's directors, creditors, or even the courts can appoint an administrator, and the process looks like this. The directors apply to the court to appoint an administrator. They file something called a notice of intention. Okay. Now you've got to give notice to secure creditors like banks, charge holders. In fact, sometimes banks can actually often initiate the administration process themselves. Now, once you've appointed that notice of intent, you then, or notice of appointment I should say, you also then need to go into developing an administration plan, right? So once the administrator is in place, the first task is to assess the position of the company and create a plan. And this will outline the best way to maximise value for creditors. And it might include rescuing the company as a going concern. It might include selling parts of the business off, hiving certain parts that are profitable off. And it might be liquidating some of the assets if a rescue isn't feasible. Now then we've got to look at the outcome, step 3. Now there are 3 possible outcomes of an admin. Number 1 is rescue. The administrator may implement measures like cost cutting, securing new investment, or restructuring debts to save the business. Now, the second option here would be a sale of the business. In a pre-pack administration, the business and its assets are sold to a new owner, and it allows operations to continue seamlessly. Now, these assets and the business could be sold to the same directors that put it into liquidation, into administration. It happens all the time. And the third option is closure and liquidation. If the rescue or the sale isn't possible, the administrator is going to oversee the sale of the assets and distribute that to the creditors, okay? Now, I touched on a pre-pack administration, and I'm going to go into that in a little bit more detail. And this is where the business and its assets are sold to a new owner, okay, but often a connected party. And I'll start that again. In a pre-pack administration, the business and the assets of the business are sold to a new venture, a new company, often the same directors as the business that put it into a process. And this way, it generally delivers a better return for creditors compared to shutting down entirely. And it ensures the business's value isn't lost, okay? Now, pre-packs have got to be handled with transparency to avoid challenges from creditors who feel that the process was unfair. And the administrator is going to demonstrate that the pre-pack was in the best interests of all the creditors, okay? Now, while an administrator takes over full control of the company during admin, directors still have got a responsibility. And these really include cooperating fully, provide accurate financial records, disclose all relevant info, and respond promptly to any of the administrator's requests. Because any evidence of misfeasance, wrongful trading, asset undervaluation, it could result in serious problems for you, the director. Now, I want to address a few questions that people ask about administrations. Now, the first question is, can I still be involved in the business after an administration? And in most cases, yes. If the company sold through a pre-pack deal, directors often stay on to help to manage the transition, and they even normally head up the company that is buying the business in the pre-pack. What happens to employees during administration? So your employees are protected under 2-pay, okay? So if the business is sold as a going concern, they get moved over. Otherwise, redundancy may occur. Now, what happens if a business can't be rescued? If a rescue is not possible, the company's assets are sold and the proceeds are distributed to creditors. It's a full stop. And again, with these things, I say it all the time, the key thing is early action, okay? Taking action before things get too painful. Now in this section, I'm going to talk about selling assets. Not just selling company assets, but selling them in the right way. Whether they're going through liquidation or an administration, selling company assets is a critical part of most processes. It's how funds are raised to repay creditors, but it's also an area where directors often face the most scrutiny. So in this section, I'm going to explain the right way to sell assets, avoid common pitfalls and maximise value while staying compliant with the insolvency laws. So let's start with why selling assets properly is so important. So during liquidation or administration, the assets of a company, whether it's stock, equipment, vehicles, intellectual property, they're all used to repay creditors. And the goal is to maximise the return for creditors while ensuring the sales are fair and transparent. Now, people go, well, what's a company asset? Well, a company asset includes everything of value that belongs to the business. It could be physical assets, vehicles, machines, office equipment, inventory, fixtures, intellectual property, trademarks, patents, copyrights. There's all sorts of manner of things. And then there's financial assets, cash, money due in, investments, property, offices, warehouses. Even things like, customer lists or goodwill can hold value and may be sold during the process. Now, how assets can be sold pre-liquidation. This is dead important because a lot of directors will sell assets before they appoint a liquidator. Okay? Now, this can be done, but you've got to be super careful. If you are insolvent and you are planning on appointing a liquidator and you want to sell assets, even if you want to sell them to yourself, you have got to ensure that it's done through an independent valuation. And this is to ensure that they are sold at the market value. Okay? Super, super important. You need to get in a valuing agent, okay, who are independent, who are well respected, and let them conduct an independent valuation. They're not like a recommendation, it's like a requirement. You've got to do this. And the reason you've got to do it is if a valuer's come in and said your assets are worth this much, and you've then sold them to your new company for more or the same what the valuer has said they're worth, nobody can criticise you for it, okay? It's protecting creditors' interests, but it also protects you and it prevents legal issues. Because if you sell assets below market value, that's where you're going to be accused of misfeasance, and it could result in personal liability or even director disqualification. It's all about transparency. An independent valuation provides a clear paper trail showing that the sale process was fair and above board. And it's the same with administrations. If you're buying a business out of administration, there are rules for selling assets during admin. The process of selling assets in administration, it's a little bit different because the administrator has got broader powers to sell the assets as part of a rescue plan. It's not you who's selling them, right? So the administrator, they might sell assets individually or they might sell them as part of a package to preserve value of the business. Now, in a pre-pack sale, the business and its assets are sold to a new company, and the deal is done sort of as what happens is you notify the courts that you want to appoint an administrator, and then the agent will do a marketing period on that business. So the agent will try and sell the assets of that business over a 5 to 10 day period through, advertising, email lists. But I've done many of these over the years. Even though it's been marketed to the outside world, very rarely does anyone come in to try and buy that business. And the key reason is the most value generally is for the director of Oldco to buy it out of administration. And they put a formal offer in, it gets accepted, and then the sale is completed. And the new business can start operating under the new company preserving jobs and values, okay? Benefits, there's obviously continuity. Customers will experience minimal disruption. Staff will keep the jobs. There'll be higher returns for creditors because the money that's coming in from the sale of the business will go back to paying some of the creditors what they're owed. But remember, an administrator has got to justify that the deal is in the best interests of creditors. So you've got to avoid being criticised, and the key to avoid being criticised is to follow process. Speak to the insolvency practitioner, make them aware of what's going on, especially if you're doing this in a liquidation scenario. When it's an administration, it's a little bit more controlled. But if you're thinking of selling assets in a liquidation scenario, it's really important you get an independent valuation, you keep the insolvency practitioner updated of what's going on, and you can do it without the threat of legal action down the line. Now, another way of closing a business is a compulsory liquidation. Now, a compulsory liquidation is a very different beast from a voluntary liquidation. A voluntary liquidation is you take control of the process. Compulsory liquidation is forced upon you by a creditor that you owe money, okay? The creditor has a legal right to file a winding up petition at the court, and once the court grants the petition, the company is placed into compulsory liquidation and control is handed over to the official receiver or a liquidator that you don't know is appointed. Now, a winding up petition is a formal legal request made by a creditor to the court asking that your company be liquidated because they can't repay, but basically you can't pay your debts. And here's how that process works. The first step is they file the petition. The creditor files a petition with the courts and it's served on the company. The petition outlines the amounts owed and explains why the company cannot pay. Then the petition is advertised in the London Gazette. It's then public knowledge. And this can trigger a chain reaction where other creditors or banks start to take action, like your bank account will get frozen by the bank. There's a court hearing and the court decides whether the company should be placed into compulsory liquidation, and if it's granted, the official receiver is appointed to take control. Now, what happens once a company is in compulsory liquidation? The official receiver takes control, and this is a government official, and they're going to investigate the director's conduct. And straight away, right, your conduct's into question because you could have done this voluntarily and essentially you've buried your head in the sand. It's a big red mark against your name. Now, what they're going to do is conduct a detailed investigation into the action of you, the director, leading up to insolvency, and any evidence of misconduct, wrongful trading, misfeasance, it's going to result in personal liability or disqualification. Any asset sales that you made, any creditor payments that you've made, they're going to be scrutinised closely. You've got to avoid this, guys. Please, the consequences of a winding up can be so severe, especially if you don't act quickly. Your bank accounts are going to get frozen. The minute somebody tells you that they're threatening you with a winding up petition, you've got to take advice early, right? You pick the phone to us up now. You don't need to panic, but you've got to act immediately. Because let's say the petition comes through your door today. It's not necessarily been advertised. You've got time to go to court, get an adjournment and get the business potentially into some type of insolvency process that's been initiated by you voluntarily. Whatever you do, please, 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 if you've received a winding up petition or someone's threatening you with them, you've got to pick the phone up to us today. The consequences of getting compulsory wound up are always worse than voluntary liquidation, okay? I mean, I'll compare the two for you. A CVL, liquidation, is initiated by you. It shows responsibility. Compulsory liquidation is forced by the creditors. In a liquidation, you've got control. You can appoint the liquidator. In a compulsory liquidation, it's the official receiver. You've got no control. In a liquidation that's voluntarily done, you've protected your reputation a little bit. If you're at the risk of compulsory liquidation and you get wound up, your reputation shows that basically your actions are you've buried your head in the sands. It must be avoided. Now, my final part of this video is going to be talking about a Members Voluntary Liquidation, or MVL. And it's very different from the other forms of liquidation we've discussed before. If your company is solvent, meaning it can pay off its debts and still have money left over, an MVL is the most tax efficient way to close a business. Whether you're retiring, restructuring, or moving on to a new venture, it allows you to distribute the remaining assets to shareholders in a way that minimises tax liability. Now, what is an MVL? An MVL is a formal liquidation process used for solvent companies, and it allows directors to wind up the company and distribute any remaining funds or assets to shareholders. And the key benefits is, unlike simply withdrawing the funds as dividends, which will be taxed as income, an MVL allows distributions to be treated as capital gains, and this makes it far more tax efficient option for directors and shareholders. Now, if you're thinking whether you should consider one of these or not, maybe think about this. Are you retiring? Many directors use an MVL to close the business as part of the retirement plan. Maybe you're restructuring. An MVL can be used to simplify or reorganise a group of companies. The company has some surplus assets. If your company has significant cash reserves or assets to distribute, an MVL may be a tax efficient way to do it. Now, as with everything, this is down to the specifics of your situation. You need to take advice on this. But one of the things you might qualify for with an MVL is business asset disposal relief, formerly entrepreneurs relief, and it reduces the tax rate to as low as 10%. Okay? So I'm going to give you some ideas of what the steps are. Here is an MVL and the step by step. First, we've got to confirm insolvency. You've got to confirm your business is solvent, and as a director you sign a declaration of insolvency, which is a formal statement that says the company can pay all its debts in full, including interest, within 12 months. The company's got no hidden liabilities or any unresolved disputes. It's a legal document, so it's critical that the company's finances are thoroughly reviewed before you sign it. If it turns out the company isn't solvent, the process could convert to a voluntary liquidation, okay? This declaration may be scrutinised for accuracy. Step 2, you appoint a licensed insolvency practitioner. Once you've confirmed solvency, you need to appoint an IP. And the IP will take control of the assets and the accounts and oversee the distribution of assets to shareholders, ensuring all the legal and tax requirements are met. And this is where the expertise of a liquidator ensures the process runs smoothly, protecting both the directors and shareholders. Okay? Step 3 is the assets are distributed. After the liquidator takes control, they'll sell any remaining assets or distribute them directly to shareholders. And here's how it works. Cash reserves. Any money in the company's account is distributed as part of the MVL. Physical assets. Equipment, vehicles or properties can be sold or distributed directly to shareholders. Intellectual property. If the company owns trademarks, patents or softwares, these can be sold or transferred. Okay? So it's a really, really clean process and fairly straightforward. And again, if you're looking at an MVL, please take some advice. I hope you found this video useful. My name is Chris Worden and I'm from Director First. Thank you.